everyone, and happy Thanksgiving. Nick Ryder here with another edition of Kathmere's Chart of the Month. As we head into the home stretch of 2024, we're also entering what I refer to as prediction season. It's the time of year when the lead market strategists at Wall Street's investment banks participate in the annual ritual of publishing their predictions for where the S&P 500 will be at the end of next year. Generally, these forecasts garner quite a bit of media attention in the press and on the financial news shows. On any given day, we're likely to see at least one of these market strategists on the airwaves elaborating on the logic behind their precise forecast for what we can expect in the year ahead. I'll readily admit that every single one of them is exceptionally articulate and their reasoning appears unassailable. After all, these market strategists are among the brightest minds on Wall Street and are backed by the immense depth of their respective firms' resources and are afforded unrivaled access to those in leadership positions in both the private and public sectors who are in the know. Nevertheless, a very real question remains. Should serious investors put much faith in these forecasts and rely on them when making investment decisions? The short answer is no. In past commentaries and webinars, I've shared research demonstrating that naively guessing that the market would rise by 9 or 10% in the following year, roughly the market's average annual return over the last century, would result in a lower margin of error on average than would relying on the average of Wall Street's forecasts. 2024 once again demonstrated the futility of trying to guess the short-term market performance. Presented in this month's Chart of the Month, I plot the year-end 2024 price targets published by 20 leading Wall Street firms during December of last year against the actual current level of the S&P 500 today. The gray bars on the chart represent the individual year-end index level targets. The blue bar represents the median target, and the green bar represents the S&P 500 index level as of last Friday, November 22nd. As of last December, when these forecasts were being published, the S&P was trading around 4770 plus or minus a couple percentage points. The median forecast across the 20 called for the S&P 500 to finish 2024 at 4875, which represented a gain of a bit more than 4% for the year from the then prevailing levels. The most bullish forecast called for the index to climb 16%, and the most bearish predicted a 10% drop for the year. As of last Friday, the S&P stood at 5969, which is fully 22% above the median forecast. Amazingly, even the most bullish undershot by more than 15%. Put simply, Wall Street once again widely missed the mark and did not see this year's market rally coming, just like they didn't see last year's rally either, or 2022's sell-off. The stark reality is that attempting to guess the short-term direction of the stock market is a fool's errand, as markets routinely have a way of humbling those who believe they can do so. So why do these firms continue to publish these forecasts despite their demonstrated uselessness? I can't fully say for sure, but I believe it's simply because there continues to be a market demand for them. In other words, people want these predictions. People love predictions because they reduce uncertainty. Even when we know the predictions are no good, we still want them because uncertainty is uncomfortable, and when someone makes a prediction, it reduces the uncertainty in our head and provides us with some measure of comfort that perhaps the world isn't as highly unpredictable and uncertain as it really is. There's a story about the Nobel Prize-winning economist Kenneth Arrow and his team during World War II that I love that's illustrative of this point. During the war, Arrow was assigned to a team of statisticians to produce long-range weather forecasts. After working on the issue for some time, Arrow and his team determined that their forecasts were no better than pulling numbers out of a hat. Concluding that their efforts were in vain, they wrote their superiors asking to be relieved of the duty. They received the following reply. The commanding general is well aware that the forecasts are no good. However, he needs them for planning purposes. The takeaway, don't be like the commanding general. Don't expect someone to do the impossible and predict the unpredictable. Ignore the useless forecasts. Instead, focus on the long term and on controlling what you can control when managing your wealth. That's what we do day in and day out for our clients. That's all for this month. Thanks for joining us, and we'll see you next month.